Good morning, Mary, joining us from GM's headquarters in Detroit. Mary, I want to ask you about
what happens when tariffs slam into one of America's biggest automakers, costing $1.1 billion in just one quarter.
Isn't happening, as you mentioned, in addition to some of the subsidies.
GM's net income just crashed 35%, and the shockwaves are hitting investors, car buyers, and the entire EV market. With 15% import tariffs locking in till 2029, prices are rising, margins are shrinking, and even entry-level EVs now face delays. Could your next car cost more or disappear entirely from showrooms? We'll break down how this crisis unfolded and what it means for the future of American auto. So stay with us, and don't forget to subscribe for more updates on how this could affect your wallet. General Motors reported a steep decline in second quarter performance, with net income falling 35%, from $2.6 billion in Q2 2024 to $1.69 billion this year. The drop reflects growing pressure from global trade tensions and rising production costs. Revenue dipped slightly from $44.8 billion to $42.3 billion, while the company's operating margin shrank, squeezed by rising input prices and ongoing shipping disruptions. These challenges largely stem from newly imposed tariffs and strained supply chains affecting key components like steel and semiconductors. Investors responded quickly. GM's stock dropped 4.7% following the earnings release in July 2025. Analysts say this is the automaker's toughest quarter since the pandemic recovery. The combined weight of increased manufacturing expenses and limited flexibility in pricing has exposed vulnerabilities in GM's global sourcing strategy. If trade tensions continue into Q3, GM may face deeper cuts or a shift in its vehicle lineup to protect margins. In the second quarter of 2025, General Motors disclosed that tariffs alone added $1.1 billion in unplanned expenses across its supply chain. A major chunk of this hit came from tariffs on imported steel and aluminum from Canada, Japan, and China, which sharply raised material costs for vehicle production. Additionally, key EV parts and electronic components sourced from Asia were slapped with a 15% tariff, further straining GM's cost structure. The impact didn't stop there. Port congestion and customs delays also led to increased shipping and storage costs, compounding the financial burden. These extra charges were difficult to shift onto customers, especially in the price-sensitive mid-range market. As a result, GM had to absorb much of the tariff impact, tightening already slim profit margins. This highlights the vulnerability of global sourcing strategies amid shifting trade policies and emphasizes the growing cost of doing business in a more protectionist global economy. The newly enforced US-Japan trade agreement, effective August 1, 2025, has placed a flat 15% tariff on selected imports, directly impacting General Motors' production pipeline. The tariff covers auto components, electronics, and hybrid system parts, many of which are essential to GM's electric vehicle manufacturing. The deal is set to stay in place until 2029, locking in higher import costs for years. GM is particularly exposed, as it relies on Japan for over 30% of its EV battery technology and semiconductor components. Industry analysts warn that this new policy could tack on an additional $600 million to GM's annual operating costs, pushing the company to reassess its sourcing strategies. With tariffs now hitting both raw materials and high-tech imports, GM faces a difficult balance between innovation and cost control. The automaker may be forced to shift suppliers or pass costs to consumers soon. General Motors isn't the only automaker feeling the squeeze from rising trade barriers. In Q2, Ford reported a 22% decline in net income, citing similar tariff-related cost pressures, particularly on imported metals and EV parts. Both Stellantis and Tesla have intensified their lobbying efforts in Washington, pushing for exemptions on critical electric vehicle components, including batteries and semiconductors. Meanwhile, the Alliance for Automotive Innovation has issued strong warnings that escalating costs could significantly slow EV adoption and delay industry sustainability goals. Automakers argue that while tariffs are aimed at boosting domestic production, they are instead disrupting supply chains and increasing vehicle prices for consumers. As trade tensions grow, industry-wide pressure is mounting on policymakers to revisit or revise current tariff policies. Without relief, automakers may face further profit erosion, reduced innovation, and slower transitions to clean energy platforms in the years ahead. In response to rising costs, GM executives, under the leadership of CEO Mary Barra, have announced a series of cost-cutting strategies to protect margins and stabilize operations. One of the key moves includes delaying the launch of lower-margin electric vehicles, particularly entry-level models that are more vulnerable to pricing pressures. Additionally, GM is pausing capital investments in several overseas factories, focusing instead on optimizing existing facilities. To reduce reliance on costly imports, the company is actively reshuffling its supplier network, seeking North American alternatives to bypass overseas tariffs. GM is also shifting production priorities toward high-margin vehicles, such as luxury SUVs and full-size pickups, to help absorb the added costs. Despite the challenges, Mary Barra reaffirmed GM's commitment to its electrification roadmap, stating, "While these tariffs present a real challenge, we remain committed to our long-term electrification goals." The moves reflect a tactical pivot aimed at long-term stability. Enjoying this? Subscribe and stay updated. As tariffs continue to raise manufacturing costs, auto analysts warn that the impact will soon reach the showroom floor. The average price of GM vehicles is expected to rise by 3 to 5% before the end of 2025, making new cars less affordable for many buyers. Entry-level electric vehicles, which were once positioned as the future of affordable mobility, may become less accessible, clashing with GM's original affordability and sustainability goals. In parallel, leasing and financing options could also see adjustments, with monthly payments increasing due to higher vehicle pricing. These shifts are drawing concern from consumer advocacy groups, who warn that lower-income households will bear the brunt of the added cost. Many fear this will widen the gap between consumers who can afford new technology and those left behind. Without policy changes or relief, buyers could face fewer choices and more expensive options heading into 2026. Rising concerns over U.S. tariff policies are drawing sharp reactions from both industry leaders and lawmakers, who argue that the economic costs are outweighing the intended benefits. The Trump camp supports the tariffs as a way to revitalize American manufacturing and limit dependence on imports. A senior White House economic advisor recently cautioned, "These policies may be politically appealing, but they undermine U.S. competitiveness." Major firms like General Motors are experiencing rising production costs and supply disruptions, pressuring policymakers for adjustments. As the global economy shifts, U.S. trade policy, especially tariff strategy, is under review with long-term consequences for industry growth and global market position. As GM struggles with declining profits and rising tariffs, Wall Street analysts are growing cautious. Goldman Sachs recently downgraded GM's stock rating from buy to neutral, pointing to global trade instability and ongoing supply chain pressure. At the same time, Moody's has raised concerns over a possible credit rating downgrade if Q3 2025 shows further weakness in profitability and free cash flow. Morgan Stanley offered a more nuanced take, calling GM's pivot to high-margin SUVs and luxury vehicles a strategic but risky bet, especially as the global economy slows. Analysts broadly agree that GM's dependence on international suppliers leaves it vulnerable to tariff volatility and policy uncertainty. With consumer demand softening and prices trending upward, GM's performance in the coming quarter, along with any shifts in U.S. trade policy, could play a decisive role in reshaping investor sentiment through the rest of 2025. In the end, it's clear, tariffs aren't just numbers on paper. They hit hard, and now even giants like GM are feeling the heat. Will rising prices force you to rethink your next car? Could this shift reshape the entire American auto market? Drop a comment and tell us what you think. Don't forget to like, subscribe, and hit the bell so you never miss an update that could impact your wallet, your ride, and the road ahead.